So I just had a lovely conversation with the IRS enrolled agent from H&R Block Advisors on INA. I wish I could have recorded it, but I was actually uploading the previous video up, so I'm sorry. And maybe the quality of the speaker or the microphone wouldn't be that great anyways. I haven't heard the first episode, so I don't know what that sounds like. But anyways, I have everything consolidated. I did ask him the questions that were previously pending, and I got some more. It's a lot of information. I've been working on this stuff for about 10 years now, and the IRS code and our government really does work in our favor. Once you start reading what the tax refundable credits are and all the tax rules, and you see where the money's going, for the most part, man, we got a really great government. Moreover, it is a lot of information. There's a lot of content here, and there's a lot of concepts, a lot of forms, but I'll try to be brief, straight to the point, and hopefully you guys learn a lot. So here we go. The last pending question that we had was, let's see, number 3, Roth tax withholdings amount of 20% on interest earned. And yes, we did confirm that with the IRS enrolled agent. So we're going to put yes. That's on the interest earned. Okay, and then whatever your reported income on your 1040 is, then that's your tax bracket, and that's what you get taxed on. So that's a big fat yes. Okay, if you guys have any questions or you want to keep talking about it, chew the cud until we make sense of things. I know I have to hear things about 10 times, ask my wife, and I still probably won't get it, but whatever. Anyways, all right, we determined that we already went over that. Oops, withholding. That we did determine. So 20% withholding on the traditional when you take it out on the entire disbursement, and then 20% interest earned on the Roth. Okay, and then it goes to the 1040, and it gets broken down again. Then you have your AGI, and you have a tax bracket, and you pay your penalty, fees, or tax obligation. All right. Okay, so on I believe it's a 1040, but whatever. Anyways, you have additions. This is addition to your income, so it's dividends, small business gains, because you're an employee of your business, so you'll probably be giving yourself a 1099, something like that. And then you come up with your adjusted gross income, which will determine your tax bracket. Additions also include qualified and ordinary dividends, which is probably the holding period. Over a year is probably qualified, and ordinary would be within the year. I'm not too sure, but it's probably 15% for this one, like short-term capital gains, and probably 25% for qualified if it were long-term capital gains. But the focal point here is that all this is included in your additions, which goes on your 1040. All right, this is going somewhere. The idea, this is going in the direction that we want to clarify whether capital gains affect your Social Security or your pensions or whatever the case may be, right? And the answer is yes, because they go on your Schedule 1, line 9. That's where you report capital gains. On Schedule 1, you report rental income as well and other things, and it goes back to your 1040. So, unfortunately, or fortunately, it is taxed and broken down into your AGI, which determines your tax bracket. Okay, we did go over Social Security thresholds. So, when you make income, let's say you make $1,000 in Social Security income per month, and you made $600 in additions and qualified income, okay? That means that 50% of 1,000 is 500. So you made $100 more Now you're going to be adjusted, right? So we have $100 that will be considered for taxation because it meets the threshold. And up to 85% of that $100, so $85, is taxable. All right? So we were trying to research let me reiterate that. So the $100, 85% or less will be taxed. So anything over $32,000, which we're only talking about $100, after you go over $32,000, 85% of that is considered for taxation, up to, right? So anything between, it's a sliding scale, just like the tax brackets, it's on the same thing. It's the same thing. And, it goes up to 85% can be taxed. It's not saying that 85% is the tax bracket. There's a certain amount that will be withheld. But just know that it's not dollar for dollar. It's on a sliding scale again. So just to reiterate that, $100 falls in between $1 to $32.99. So let's say 60% of that will be considered for taxation. If you made $32,000 over the $500, then 85% of that over the 32,000 is taxable. It's a sliding scale, just like the tax bracket. Also, it's your household income, so it's just not you. For your Social Security, threshold taxing, it's your entire household. So if you have a spouse and you're only making $1,000 or whatever the case is on Social Security, 50% of that, and you're making more. Everybody has a business. Your wife has a business. You have a business. So it's all going to get taxed. Not necessarily a bad thing. If you're not paying taxes, you ain't making money. So just something to consider. It's a household income. It's just not isolated with you and then isolated with her. Know that it's household income. Then you get your HEI. Then any income over 50% of the Social Security earnings can be taxed up to 85%. So at least we know that it won't be taxed 100%, right? And it's a sliding scale. Also, we were talking about the benevolence of the IRS code to some degree, right? Or specifically in Schedule 3, you have your tax refundable credits and tax credits. So one particular thing that I'll be doing this year is my state obligation I will be putting towards playground equipment for a low-income school. And I believe he said you can only do about 200 is a tax refundable credit. But the good thing is that you can continuously roll these over year after year after year. So if you want to give if your state obligation is $10,000, I think you can only give $1,000. That goes towards your deduction, but then $200 is your tax refundable credit. But you can continuously roll it over, so that might let you avoid paying those taxes up front, and you just continuously roll your obligation and paying out through the schools. So Schedule 3, putting money into schools, are called consumable credits. You can buy sanitizers, you can buy soap and things like that, and it can be rolled over. So, there's more to be said about that, but the thing is that you can do these unique taxing jujitsu things, and it's a benefit of the community. And you just have to take action. You have to care, and you have to read up on things. So, there you go. We clarified it. All this stuff. I'm not going to go over it. If you have any questions, email me or talk to me in person. I hope this was helpful and beneficial and clarifies any confusion. Thank you.